Welcome to Market View with Ike Iosa and Friends. This show that not only reveals and analyzes the inside story on today's market news, but also uncovers the areas where investors can make money right now.
Well, that's my good morning. Mike Houston, your host for Market View. My very good friend, Mr. Mark Arbeter. Hi, Mark. How are you?
Great, Ike. How are you?
I'm doing well, and I'm looking forward to our conversation today because we're going to talk quite a bit about Treasuries, which I believe really hold the key to what may happen in the markets going forward. So let's start with our first chart.
Okay, thank you very much. I'm going to turn things around here, not look at only a couple stock market charts, but mostly Treasury charts, yield curve inversions, and short-term rates, etc. But the first chart, fascinating chart on a log scale. This is a monthly chart of 10-year yields going back to the late 70s. And if anyone was around back in, I guess it was 1981, yields on the 10-year were up in the 15% range, and then proceeded to have a 4+ decade bull market where yields went from 15.5 to basically zero during the pandemic. But you can see, over this 40+ years, a lot of the chart, the yields, stayed in this downward sloping channel. Every time we got up towards the top of the channel, or we got to the 89-month exponential moving average, that seems to work very well over the long term. Plus, it's 89 is a Fibonacci number, probably why I picked it. But you can see every time going back, from the start to November of 2018, that was the last time we touched the top of the channel and then reversed, and then, of course, the pandemic and all that. But since the pandemic, 10-year has gone from nothing to today, where we are right near the recent highs, possibly above, around 4.17%. And clearly, the longer-term trend has changed. Bond yields, 10-year bond yields, tend to have very, very long cycles. And I think the previous cycle going up was something like 30 years. So this is not unusual to have a long cycle with yields coming down. Probably is the longest bull market in any financial markets since we began pricing things. So anyway, on the long-term chart, the next piece of potential resistance here is actually support if these were prices, but the next peak that we saw comes in back in 2006 and 2007. That's up near the 5% area. Bonds tend to gravitate towards, big numbers, 3%, 4%, 5%. But just a 38.2% retracement of this entire decline in rates is way up at 642. And this certainly would not be very good for the stock market. If we move to chart number 2, this tightens things up. This goes back to 2019. This is a weekly chart of Treasury yields, and it shows that the big run occurred basically after the pandemic lows. Kind of had a retest in July or August there of 2020. But since then, yields have been in a very consistent uptrend. At times, their moves have gotten fairly steep. We saw that in early 2021, once in 2022, and then later in 2022. And they've all been preceded by subsequent pullbacks. This time we broke this primary trend line off the lows since 2020. Sometimes the slope of an asset will reset, which looks like it's doing now. But if we look at this pause here, it was very somewhat gentle. It started here back in about October of 2022. This certainly, from a chart perspective, just looks like a bull flag. We've broken out of that bull flag, which is another negative sign for stocks. And if we look at the weekly momentum on the top, basically, going back to late 2020, there's been numerous times where we've cycled into a very overbought territory, and we've stayed basically between 40 and over 80, which is a bull range for the 14-week momentum. And interestingly, the bottom panel shows the MACD falling basically right to the zero line and turning back up. So from a super long-term perspective and a long-term perspective, the trend in yields is clearly higher. If we go to chart number 3, this is more of an intermediate chart, daily chart of 10-year. You can see going back to September about of 2022, we've basically stayed in this 3.6 to 4.33 range. So intermediate term, I would say the trend is definitely neutral. And from a shorter term perspective, though, and despite a series of better than expected inflation reports over the last many months, since about May 4th, when we bottomed down near 330, the trend has been very consistently higher in this very nice rising channel. We did see some bearish divergences here on the MACD, daily MACD, and daily RSI, but right now it looks like we're going to push higher. And definitely the key area for the 10-year on the upside would be the October 21st intraday high, up at 4.33%. We've had a couple attempted breakouts above the high in March and above the high in July. Actually, we had one attempted breakout which failed, but rates have turned back up. So if we were to take out that 433 level and with some strength and we stay above that level, I think there's a clear path to 5% at least on the 10-year. Moving to chart number 4, this is another really long-term chart going back to the late 1970s. Simply, we have the top panel, which is the 2-year Treasury yield, very similar to the 10-year to some degree. And then the second panel is the yield curve. Now, the dotted red lines, the first line back in late 78 shows when the yield curve went negative, and then the second red line there in 1980 shows when the reinverted or went back positive. That's the yield curve. And typically, you're not going to be able to see it on the bottom panel, but that led to, and we reinverted again during the early 80s, that led to recession 81, 82, and a nasty stock market during that period. The next time yield curve inverted was in 89. Then we went back positive, and at that point, that led to the 1990 bear market. The same thing happened in 2000. The yield curve inverted, and it wasn't until it went back positive that the market had trouble. Same thing, 06 to 07. This is kind of a strange phenomenon. Everybody gets worried when the yield curve inverts, but generally we don't have trouble in the equity markets and in the economy most of these times led to recessions until the yield curve goes back positive. And right now we're at about 73 basis points from going positive. So we're still a good distance away. The difference this time is that we've already had a bear market. Usually the bear markets come after we go positive on the yield curve. So that's a tough read. I don't know what that actually means, but it's something to keep an eye on. If we move to chart number 5, this is the red line is the 2-year yield going back to and then the thin black line is federal funds. So you can see each time the 2-year peaked, which was in 2000, the first dotted vertical blue line, it was months before the black line started to go down. So market rates always, at least historically, lead what the Fed does, which is not surprising. So every example on here where I have 2 lines, the first is when the 2-year peaks, and the second is where Fed funds peak or bottom. You can see that market rates have always led what the Fed does, either going up or going down. For now, if we tighten up and look at just recent history, 2-year last made its high. It was around February earlier this year. And since about October of last year, the 2-year's been kind of flat. Sometimes the 2-year will flatten out for a couple months prior to its decline, which I'm guessing that's what's happening right now, which would suggest that once we see a more consistent decline in the 2-year, that will tell us that the Fed is done. I think they're probably done here, but we need to see a consistent decline in the 2-year, and then we will have a very good signal that the Fed is done. Moving to the stock market, chart number 6. Most of the damage so far has been in the higher beta, tech-type stocks, high PE, high valuation type stocks. Triple Qs have fallen. NASDAQ has fallen a little more than the S&P. Right now, the Qs are sitting right below the blue, one of the blue lines, dark blue lines, which is 50-day moving average. We broke the uptrend off the March lows, but we're still in this bull channel here, going back to early 2023. We did have bearish momentum divergences at the last peak for the Qs. The problem for the Qs, and I'll show the same example for the NASDAQ, is that once they really started ripping higher, March and April, these indices, there wasn't a lot of sideways action. Therefore, there was very little layers of chart support that was built. And if we look at the chart, there's really very little chart support until we get down to about that 320 level, which represents a 50% retracement. That doesn't mean we have to go all the way down there. We could stop at this trend line here, which is, maybe 7-8 points and reverse, or we could retrace 38.2% and then start back up again. But I do think that this is not over yet, and would certainly love to see some kind of washout in the hottest stocks here. Moving to chart number 7, this is the NASDAQ, same thing as the Qs, very little chart support on the way down. We just sitting right near the 50-day exponential moving average, just below the full channel since March, and trendline support off the early 2023 lows. Comes in looking out like 13,000 and then 38.2% retracement and a 50% retracement where there's pretty good chart support, are in the 12.8 to 12.260 range.
Mark, anything else you would like to add?
Yeah, let's take a look at something that's actually working right now, since the stock market, the bond market, and precious metals aren't doing so well, and that would be crude oil, WTI. This is a weekly chart going back to April of 2021. You can see this big bear market that we've had going from a peak of about 130 on an intraday basis intra-week basis back in March of 2022, all the way down to an intra-week low about 63 and a half. We're slightly back above this previous high from April. We're currently at 83.70, and we're also near this breakout level that I drew with a dotted blue line here. So we're entering, we need to get above this prior high, and we'd have a series of higher highs and higher lows, which we haven't had in quite some time. And then I think the most interesting level would be a 50% retracement, because that represents prior highs from back in 2022, also represents 50% retracement, and that would be up around the 93 level. So I think crude has the wind at its back here and will push higher. And if we go to the last chart, chart number 9, the biggest beneficiary of an increase in crude oil prices has been the oil services group, OIH. You can see we put in a nice cup and broke to new recovery highs, and we've seen volume come into the stock on up days. And then the bottom panel, you can see since about the beginning of June that the OIH has really seen a lot of relative strength versus the S&P 500.
Mark, thank you. Have a great weekend.
You too, Ike. Thank you.